Hey everyone, welcome back to Corporate Decoder. Today we're diving into a 10K report, which is like a corporate diary, but instead of secrets, it's filled with numbers and legal stuff. We're decoding Starco brands, and this report seems to have more twists than a pretzel factory. First things first, Starco Brands wants you to know that this report is full of forward-looking statements. In plain English, these are guesses about the future, like whether their new product will be the next big thing or a total flop. They're saying, don't take everything here as a promise because things might change and their results might differ from what they think. This is their annual report, a Form 10K, for the year ended December 31, 2024. And the company also states that as of April 16, 2025, there were 60/40 around. The company estimates that the market value of shares held by non-affiliates was about $36.6 million as of June 30, 2024. This gives us a peek into what the public thinks the company is worth. Jumping into the business overview, Starco Brands aims to create behavior-changing products. That's a fancy way of saying they want to make stuff you can't live without. They focus on inventing brands, marketing, and social media, and rely on a licensing agreement with the Starco Group. Now let's talk about their products. There's Winona Popcorn Spray, which is sold in major grocery stores and online. Then there's Whip Shots, vodka-infused whipped cream. It's distributed in most states and the United Kingdom with new flavors popping up all the time. They also acquired The Art of Sport, Skylar, and Soylent. Each brand brings a different consumer base. Moving on to risk factors, always good to know. One biggie, they depend on related parties, especially their CEO, Ross Sklar. He doesn't spend all his time on Starco Brands, and he also owns the Starco Group and chairs Temperance Distilling. Okay, let's get into the financials. For the year ended December 31, 2024, they had a net loss of over $17 million. While that sounds bad, it's actually better than the $46 million loss from the year before. Operating expenses also decreased. For the year ended December 31, 2024, their compensation expense amounted to $9 million, a decrease of $6.8 million or 43% compared to the prior year when they issued many Whipshots holding shares. Now here's an interesting shift. The fair value share adjustment went from a $215,000 loss to a $10 vols to a $10.5 million due to a decrease in the fair value of the Soylent sellers' rights to potentially receive additional Starco shares. The company is reporting goodwill impairment losses of $14.3 million, meaning the value they estimated for the acquisition value wasn't panning out. Here's a major red flag. The independent auditor has substantial doubt about Starco Brands' ability to continue as a going concern. In simpler terms, there's a risk they might not be able to stay in business. This goes back to those recurring losses we mentioned earlier. They need to generate revenue and become profitable to survive. They also acknowledge that economic downturns, trade policy shifts, fluctuations in raw material prices, and intense competition could hurt their bottom line. In today's video, we're going to be going through how to concern is concerned about their ability to protect their intellectual property rights. Also, the company has some material weaknesses in internal controls. That means their financial reporting might not be super accurate, and they might need to restate some things, which makes investors nervous. They're also beefing up their cybersecurity because hackers are everywhere. No documents are incorporated by reference. Shares of their Class A common stock are traded on the OTC Markets Group, OTCQB Kia, under the symbol STCB. On November 27, 2023, the company adopted an equity compensation plan for employees and service providers, which authorized 100,000 shares of Class A common stock. On June 13, 2021, the company entered into separation agreements with two former board members where the company agreed to purchase an amount of the shares of common stock per month. As of January 20, 2024, the separation agreements were terminated. The company's future largely depends upon the continued services of their executive officers and management team, especially their chief executive officer, Ross Sklar. They are in the process of engaging an outsourced security firm for overseeing their cybersecurity. We'll finish by jumping to the financial statements and touching base on a few key numbers. Going concern problem is highlighted in auditor's statement, which should make investors cautious. Assets, the accounts receivable decreased from $7 million to $5 million. In general, the receivables are an important asset as they show sales that will be collected in the future. So it's generally bad when they decrease. There were $28 million in tangible assets such as trade names, meaning some of the most important perceived values of their companies is the names they made. Switching to liabilities, their liabilities overall decreased by a good margin, going from almost $58 million to $32 million. That's great. To conclude, this is a company that definitely has some challenges ahead. While the numbers show that they're profitable compared to the previous year, this is only due to bookkeeping. The core issue is that the business is still losing millions of dollars and might not make it. That said, the CEO has a large influence and has been working to turn it around and also help out financially. With the business now heavily relying on Mr. Sklar for its very survival, he is a double-edged sword. I'd say to approach with a lot of caution and be wary of the multiple risk factors outlined inside the report. Thanks for watching, and if you found this breakdown helpful, please give us a like, leave a comment, and subscribe for more corporate decoding.